The White House has just begun floating the concept of placing a price floor under critical minerals at the exact moment crypto is getting hammered, and they're blaming the violent swings on unstable markets. And honestly, I wasn't even planning to make this video. I'm literally sitting here trying to drink a cup of coffee that's already gone cold while my inbox is blowing up. And then I hear that we're suddenly talking about price controls for metals in the same sentence as a Bitcoin sell-off. And it gets under my skin because the surface level narrative is not the real story. And if you own gold, silver, mining equities, crypto, or even just boring old cash sitting in a bank account, you deserve the full picture. It's Thursday, February 5th, here in New York. Drop a comment with the day and date you're watching from. And one quick thing before we dive in, I'm running a campaign to shut down copycat channels. If you appreciate what we do here, hit subscribe and comment our John AG so I can tell the real community apart from the clones. Now let's begin exactly where this all begins, with a speech that sounded dull on the surface but could end up shifting trillions of dollars. A senior official stepped up and essentially said, "The global market for critical minerals is broken. Supply chains are fragile, overly concentrated, and easily weaponized. Prices are pushed around by forces that don't care about your local mine, your local jobs, or your national security." Then came the sentence that should have made you sit up a little straighter. Make prices more predictable, less volatile, and suddenly investment shows up. Sounds harmless, right? Stability, predictability. Who could possibly object to that? But the instant you hear the phrase price floor, you should immediately start asking questions. A price floor for what, exactly? Who pays for it? How is it enforced? And for how long? Here's where the word floor starts to get slippery. Governments almost never put up a big flashing sign that says, "This is the price." They operate through plumbing, contracts, incentives, procurement rules, and mechanisms boring enough to slide right past most headlines. It might look like multi-year offtake agreements where a government-backed buyer commits to purchasing a minimum quantity at a minimum price. It might look like tariffs that punish imports priced below a certain level. It could look like a strategic stockpile that steps in when prices collapse, not to make anyone rich, but to keep a supply chain alive. And the first announcement is never the policy. The real policy is the follow-through, because markets always test you. If you say, "We will defend this level," the fastest way for traders to make money is to shove that level and see if you flinch. So if this becomes real, expect stress tests. Expect failed attempts, and then expect the final outcome to be decided in the boring details. How much money is actually allocated, what qualifies as eligible material, and whether allies truly coordinate. That's why I'm watching this closely. There's a version of this that's just common sense. Strategic stockpiles, long-term contracts, government acting as a buyer of last resort when dumping nukes a project. And then there's another version that turns into a clumsy, expensive, politically convenient machine that backfires the moment the market smells blood. And here's the part most people are completely missing. This isn't only about lithium, nickel, or rare earths. The moment you set a precedent that Washington will coordinate price floors for strategic commodities, what do you think the gold and silver crowd hears? They hear the government admitting that volatility itself is a national security threat. They hear someone talking about installing guardrails around the inputs that power modern civilization. And then the obvious question follows. If you can do it for the critical stuff, what stops you from trying it with the monetary stuff? That's why this matters. Before we go any further, we need to talk about the price action that's making people emotional. And I get it. Over the past few sessions, silver has been bucking around like it's trying to throw riders off a mechanical bull. One moment it's ripping higher, the next there's an air pocket out of nowhere. Gold does the same thing, just wearing a nicer suit. Based on recently published data, spot gold has been hovering in the high 4,000s per ounce after printing a fresh record late last month. Silver has been battling in the high 70s to low 80s zone, with violent intraday spikes and brutal reversals. And if you've ever felt like metals rise in the dark and fall in the daylight, you're not imagining things. I'm not accusing anyone of anything. I'm just pointing out that quiet hours mean thin liquidity, and thin liquidity is where strange things tend to happen. If you believe that's all coincidence, that's fine. I'm not here to take that belief away from you. Now here's the detail that makes this entire episode feel wrong. Paper prices and physical prices are telling two very different stories. On a US futures screen, you see one number. On the ground, in the real world where people actually take delivery, you see another. And right now, that gap is not subtle. In Shanghai, silver has been trading meaningfully above US futures references, with a double-digit percentage premium that keeps snapping back even when paper prices sell off. Read that again. If silver were truly abundant, buyers in one of the world's largest industrial regions wouldn't be paying a fat markup just to get their hands on it. So when someone says, "See, price dropped, problem solved," I have to laugh quietly into a pillow. A lower screen price doesn't magically refill vaults. It doesn't instantly increase mine supply, and it definitely doesn't reduce demand from electronics, solar, data centers, and everything else that consumes silver like it's wiring for the future. Now let's talk about the thing that quietly drains regular people's wallets, the spread. If you've never bought physical metal before, you look at spot and think, great, that's the price. Then you try to buy and get hit with a premium. Then you try to sell and get hit again, except this time in reverse. It's basically a discount, a thank you for playing fee. And right now, those spreads are nasty. Some dealers are quoting buy premiums in the low double digits. Others are offering well under spot to take metal back because they're terrified that the next 24 hours brings another face-ripping move, leaving them stuck with inventory that reprices lower before they can hedge. So let's be honest. If you're buying physical metal expecting to flip it tomorrow, you're playing the wrong game. Metals aren't a day trading toy. They're long-term insurance, and insurance always has an upfront cost. Here's another trap people don't notice until it hurts. On days when silver and gold are moving fast, the spread isn't just a dealer being greedy. It becomes a risk management tool. If a shop buys from you at full spot and the market collapses before they hedge, they can get wiped out. So they widen the bid. They widen the ask. They're trying to survive. That's also why insane premiums don't automatically mean a shortage tomorrow. Sometimes it simply means inventory is thin and nobody wants to be the last one standing still. So don't just look at the premium. Look at how long it lasts. Watch whether it tightens when volatility calms down. That's where the real signal lives. Back to the speech. The official described a pattern every commodity trader knows by heart. A domestic project gets announced, capital lines up, the economics look workable, and then, almost magically, new foreign supply appears, prices collapse, investors vanish, and the project dies. Have you seen this movie before? Of course you have. That's dumping. That's predatory pricing. That's a strategic maneuver disguised as free market behavior. And in critical minerals, this isn't just economics. It's geopolitics. So when you hear price floor, you have to translate it. It could mean, we'll guarantee demand and a minimum price so you can finance the mine. Or it could mean, we're going to distort the market and hope it doesn't blow up. Here's my skeptical take, because skepticism is required. Price floors only work if three things exist at the same time: a credible buyer, a credible enforcement mechanism, and a credible willingness to keep buying when it hurts. Without those, the floor is just a press release, and markets eat press releases for breakfast. But the fact that this conversation is happening at all tells you something important. Policymakers are finally admitting that the invisible hand hasn't been free. It's been getting its wrist twisted. A mineral summit this week included explicit discussion of coordinated pricing floors among allies, framed as reducing dependence on a single dominant supplier. That's not trivial. That's an admission that the old system failed to deliver resilience. And here's the twist. The same people asking for stable pricing in minerals are watching the monetary system wobble, which brings us to the other headline: crypto melting down while metals refuse to die. Bitcoin has been sliding hard this week, briefly tagging levels around 70,000 after a broader tech-led risk-off move. If you're a crypto person, you'll shrug and say it's volatility. If you're a metals person, you'll say, welcome to my Tuesday. And if you're a normal person, you're wondering why everything you own seems connected by the same invisible wire. Because it is. When large portfolios de-risk, they sell what they can sell, not what they should sell. Liquidity becomes the weapon. Correlations rush toward one. That's why on ugly days you'll see stocks down, crypto down, and metals down together until the dust settles and true safe havens reassert themselves. In the middle of this, a well-known business personality dropped a take that went viral. Nobody's buying gold. Try to sell a big amount and see what happens. You'll get offered way under spot. Meanwhile, crypto is instant. Let's slow this down. There's a kernel of truth buried under a mountain of nonsense. The kernel of truth: if you walk into a random shop with a pile of metal and demand instant liquidity at full spot, you're going to be disappointed. The dealer has to verify authenticity, manage price risk, and they're not a charity. The mountain of nonsense is the leap to, this proves metals aren't real, and crypto is. Reality is boring. Different assets have different settlement rails, fraud risks, liquidity profiles, and roles. Gold is not meant to be a 5-minute flip, and if your argument is, I can move crypto fast, congratulations. You just identified the same feature that allows it to crash fast. Here's a simple question. If instant settlement equals real, why isn't a wire transfer the greatest asset on earth? Exactly. Let me push back harder. When you talk about selling $10 million of anything, you're not in the same market as the guy buying one coin. Institutional gold trades with spreads that look nothing like retail coin spreads. It moves in large bars through secure custody chains with tight pricing when you're using the correct channels. So using retail spreads to argue that nobody's buying is like judging the housing market by the offer you got for your used couch. Now let's pivot, because this next section is where people make decisions that actually change their lives. Price targets. Several major financial institutions have been floating aggressive gold forecasts lately, numbers that would have sounded insane just a couple of years ago. Recently published projections have put end of next year gold targets in the low 6,000s per ounce. Believe those numbers or don't. The real question is why those forecasts exist at all. Central bank demand, reserve diversification, and a deep persistent distrust of paper promises. Central bank gold buying remained historically elevated throughout 2025, with hundreds of tons added globally. One more point people underestimate: the psychology. For years, gold was treated like an old man asset. Then price action started behaving like a momentum trade. Now mainstream retail has been creeping back in through funds and simple brokerage products, which is part of why swings are getting sharper. That's not automatically bullish. Retail can be hot money. Retail can chase trends. Retail can puke at the worst possible moment. But it does change the market's character. The next pullback can feel like the end of the world right before it becomes the next launch pad. If you want a simple way to sanity check silver versus gold without turning into a spreadsheet goblin, watch the ratio. When gold looks expensive relative to silver, silver bulls shout catch-up trade. When silver looks expensive relative to gold, gold bulls say quality over chaos. Either way, the ratio shows you where the crowd is leaning, and crowds are often wrong at turning points. Price targets make great thumbnails. Positioning creates real outcomes. This isn't retail panic buying. This is institutions with infinite time horizons saying, we want less exposure to someone else's IOU. Does that guarantee straight line upside? Absolutely not. In fact, here's something that might irritate gold bugs. The higher prices go, the more violent pullbacks tend to be. Profit-taking increases. Leverage gets flushed. But structurally, the bid under gold has been real. Silver is a different animal, and that's why it's both exhilarating and terrifying. Silver has industrial demand. Silver has a much smaller market. It squeezes harder, and it gets punished harder when liquidity dries up. If you're going to play silver, you have to accept that it can feel like a roller coaster designed by a psychopath. Another data point caught attention: reports of physical tightness and premiums, not just in China, but elsewhere too. When multiple regions are paying double-digit premiums for physical metal, that's not a nobody wants it narrative. That's paper discounting something physical is pricing in. But interpretation matters. There are two explanations. One, physical metal is genuinely scarce. Two, logistics, taxes, and friction are creating regional premiums without implying global scarcity. For example, Shanghai's premium calculations can be distorted by tax treatment and import constraints. That's why you can't just eyeball one number and scream shortage. I'm not cheerleading here, I'm trying to think. There was also chatter about a massive bearish bet against silver, some big player leaning heavily short right before a nasty drop. Maybe it's true, maybe it's exaggerated, but even if it's real, big shorts don't prove silver is doomed. They prove silver matters. Nobody builds a $500 million position against something they think is irrelevant. They do it because the payoff is massive or because they're hedging exposure you can't see. That leads us to the vault flow obsession. People love watching metal move in and out of vaults like it's a live scoreboard. And yes, when major exchange warehouses report large drawdowns, it can matter. Recent Asian exchange data has shown notable inventory swings, consistent with the broader theme. Physical metal is being pulled into the real economy. Just don't treat one day of inventory change as prophecy. Treat it as a clue. Before my guest reacts, I want to remind you of a line you've heard before. A legendary macro voice has said for years that fiat systems are stressed, debt piles are massive, and central banks choose gold because it's the one reserve asset you can't print. You don't have to worship that argument, but you do have to grapple with it. If the largest institutions on earth are stacking gold, while policymakers discuss stabilizing commodity prices, you have to ask whether we're entering an era where governments openly manage more strategic prices, and what that means for your savings. My guest's take was blunt. The speech sounded right but hollow. Not because the problem isn't real. Supply chains are brittle. Markets get dumped on. Domestic projects die. But because the plan wasn't quantified. Which minerals? Which mechanisms? How do you measure stability? He went full engineer brain. Volatility is measurable. If you're going to manage stability, you need a defined target and a defined tool. Otherwise, you're just waving your hands over a bonfire and hoping the flames behave. He also dropped a line that split the audience in half. Much of this mess is policy-created: subsidies, distortions, bad incentives, and political games that encourage dumping and hoarding. His solution was simple but uncomfortable. Stop pretending the market is free when it's clearly managed. Either make it actually free or admit you're managing it and build systems that don't collapse under hypocrisy. I don't agree with every word, but I agree with the core. You can't fix what you refuse to describe. So the honest answer on metal price floors is still to be determined. But even to be determined matters because it tells you the conversation is shifting. We then pivoted to the viral rant about gold liquidity. My guest took the opposite side of the crypto is better argument. Metals aren't meant to be flipped. If you bought precious metals expecting to cash out tomorrow, you misunderstood the product. Gold isn't a trading chip. It's a reserve, an asset you hold when you don't fully trust the rules of the game. And then he dropped a line that deserves to be tattooed on your brain. If you can't stomach volatility, your position size is wrong. If you're losing sleep, you're too big. He also challenged the Bitcoin safe haven narrative. I'm more nuanced than either camp. Bitcoin isn't gold, but it isn't nothing. It's a network with real adoption and real liquidity. The problem is that it trades like a risk asset under stress. Today was a perfect example. Bitcoin fell sharply alongside global tech and risk assets as investors sought traditional havens. If your plan is Bitcoin saves me in chaos, you need to define what chaos you mean. In a standard risk-off event, Bitcoin can trade like a leveraged tech stock with a cooler logo. Drop a comment answering this. Do you want governments to try setting price floors for strategic commodities, or do you want truly free markets, even if that means brutal boom-bust cycles? Your answer says a lot about how you see the next decade. Now the Bitcoin meltdown segment, a rumor spread about an emergency meeting overseas and a massive liquidation of US assets to defend a currency. Maybe it's real, maybe it's social media fan fiction. Either way, the rumor itself tells you something. Currency stress is back. You don't have to believe the wildest version to take the signal seriously. We know from recent data that currency and rate expectations are shifting and that the dollar firms during risk aversion. We also know commercial real estate isn't healthy. Office-backed CMBS delinquency has climbed into the low 12% range, hitting record highs. Delinquency is like mold. If you see it in one corner, it's probably in the walls. People say, we're not in a recession. Maybe not officially, but leverage doesn't care about labels. If overpriced tech, shaky offices, and stretched consumers coexist, any shock can cascade quickly. Bitcoin's move isn't happening in isolation. On the actual tape, Bitcoin slid towards 70,000, not because one person hit sell, but because the entire risk complex wobbled. When big red candles appear, people invent stories. Whales, institutions, shady exchanges. Sometimes those stories are true. Often they're cope. The simplest explanation, thin liquidity, forced selling, and leverage, is usually the right one. After every flush, the pump squad appears. You know them. Bitcoin to 1.5 million, 10 million, 100 million. Always delivered with the confidence of a guy selling miracle vitamins from a trunk. My question never changes. What's the mechanism? Don't give me a destination without a bridge. If you can't explain the bridge, you're not explaining. You're marketing. Volatility can reward disciplined people. If you have more time than money and you study, volatility is opportunity, but it's also a guillotine for the lazy and overconfident. If you've navigated this successfully, share your story in the comments so others can stay motivated. Now we move to something most finance channels avoid, accountability. I'll keep this short. It matters because the same pattern repeats everywhere. Who pays, who benefits, and who escapes consequences? My guest wrote an advocacy document, a case study, about a county-level tax assessment system allegedly rigged through incompetence, conflicts of interest, and refusal to conduct a real forensic audit. The hook is brutal. Someone acted like they wanted truth, pushed for an investigation, then steered the board toward a feel-good review instead of a forensic teardown, a fluff piece instead of a microscope. If you've ever watched a corporation investigate itself, you already know the ending. His point was simple. Real fraud isn't solved by vibes. It's solved by evidence. He argues a proper forensic audit could document the mechanics in days, not months, if you know what data matters. Because that didn't happen, he's releasing a scope of work template anyone can adapt so boards can't pretend ignorance. The link is below. No paywall, no gimmick. What does this have to do with gold and silver? Everything. The macro is built on the micro. When people lose trust locally, tax systems, bonds, governance, they look for assets outside the system. Gold doesn't surge just because inflation exists. Inflation always exists. Gold explodes when credibility collapses. He went further, arguing the root cause is accountability. Officials approve massive debt. Consultants justify it. The same people spending your money get paid to tell you it's fine. Years later, the bill arrives. He cited rising municipal and school district bond burdens and warned households get crushed not just by principal, but by compounding interest. To ground this, we already mentioned office CMBS delinquency at record highs. Stress isn't isolated. Lenders and insurers are repricing risk across entire categories. That's not ideology, that's math. He tied it to power grids and data centers, warning that massive upgrades will be financed with more bonds even as systems strain. Then he asked the uncomfortable question. If the money doesn't exist today, how does it magically exist tomorrow? My counterpoint is simple. Governments can raise taxes, cut spending, or inflate obligations away. They can force resources to appear. The real question is, what kind of society emerges afterward? The document then took a philosophical turn, quoting an old revolutionary writer on power and control, modernized into a warning about governments picking winners and losers. Agree or disagree politically, The deeper point stands. Once systems start managing outcomes, they rarely stop at one. That loops us back to the beginning. Price floors, commodity stability, strategic stockpiles. These are signals about how leaders view the world as something to manage, not trust. That's why gold and silver keep resurfacing even when crypto is shiny. So here's my second question. If you've tried to buy or sell physical silver in the last 30 days, what premium or discount did you actually see? Real experience beats hot takes. Let's land this. We started with governments floating price floors to keep supply chains alive. We watched metals whip around while physical premiums refused to disappear. We watched crypto fall with risk assets and relearned that instant doesn't equal safe. And we ended by remembering the trust problem isn't just macro, it's local. The practical takeaway is this: don't confuse price with value. Don't confuse speed with safety. Don't confuse headlines with mechanisms. And don't put yourself in a position where one bad day forces you to sell what you meant to hold. Subscribe so you don't miss the next update. This story isn't over, it's about to get stranger. And if you've been successful navigating this, share your story below so others can stay motivated. None of this is financial advice. I'm just breaking down public information and market behavior in plain English so you can think for yourself before you push any buttons with your money.